What's up, family? This is your boy Ivan Hall, the Credit King. Do you know how to refinance your mortgage? The process of replacing your existing house loan with a new one is known as mortgage refinancing. The previous loan is paid off by the new one during refinancing, leaving the borrower with only one loan and one monthly payment. Borrowers refinance for two basic reasons in the majority of situations. The first is that they want to take advantage of the equity they've built up over the years. Another common reason for refinancing is to replace the current rate or conditions of their existing mortgage, generally with a cheaper rate or a shorter loan term. Apart from those two primary reasons, refinancing can also be done to remove another individual from the mortgage, which is common after a divorce. Even though it incorporates many of the same procedures, the refinancing process is usually less time-consuming than the home buying process. While predicting how long a refinancing will take is tricky, the typical schedule is between 30 and 45 days. The following are the major phases in the refinancing process. Step 1. Apply to refinance your loan. The first step in refinancing a mortgage is to contact your lender and request a refinance. When you apply, your lender will ask for the majority of the information you provided when you purchased the property. Lenders will look at your income, assets, debt, and credit score to see if you fulfill the refinancing conditions and can pay back the loan in full. A lender will usually request the following documents: pay stubs from the last 2 months, W-2s from the last 2 years, the last 2 bank statements. If you're married, your partner will be asked for these essential documents as well. Self-employed people can expect to give additional income evidence so that the lender can properly assess their risks. Step 2. Choose an interest rate. You may be given the opportunity to lock in your interest rate before the loan closes after approval. It normally takes 15 to 60 days to lock down a rate. The duration of the rate lock period is usually determined by a number of criteria, including your region, loan type, and lender. Loans that do not close before the lock period expires may need to be extended, which may incur additional fees. Lenders may offer you the option of fluctuating your rate in addition to locking it in. You choose to avoid locking in a rate before the loan closes by floating your rate. This may offer you a better chance of getting a lower rate at closing, but it also puts you at risk of paying a higher interest rate than the planned lock rate when the time comes. Step 3. Underwriting. Following the basic stages of applying for refinancing and locking down your interest rate, underwriting is the next step in the refinancing process. The lender will begin the process of checking that all of the material given is accurate after the application has been submitted. Lenders will examine the specifics of the property in question, including when you purchased it as well as the appraised worth. The refinance evaluation is crucial to the refinancing process since it decides the alternatives you, the borrower, have. Those seeking cash from their refinancing must ensure that the home's worth is sufficient to obtain the funds they require. Borrowers who want to reduce their monthly payments must have enough equity in their houses to avoid paying private mortgage insurance, PMI. Step 4. Have your home appraised. Before a borrower may refinance, a house appraisal must be completed. The lender will want appraisals. An appraiser will visit the property and provide an estimate of the home's value after everything is in place. If you want your house assessed for a top price, you need to make a strong first impression on the appraiser. Make sure your home is clean and any small repairs have been completed before the appraiser arrives. You should also make a list of the upgrades you've made to the house so that the appraiser is aware of the changes. The underwriting procedure will be completed if the home's worth is equal to or more than the loan amount you're trying to refinance. These steps can increase your chances of getting your home appraised for top cash, but what should you do if the estimate is lower than you anticipated? Borrowers can either reduce the amount they want to refinance or cancel their refinancing application entirely in this situation. Step 5. Closing on your new loan. The next step is to close on your new refinance loan when the underwriting and house appraisal processes are completed. You should anticipate a closing disclosure paper 3 days before closing that will provide you with a full summary of the details of your loan. The closing of refinancing is usually significantly faster than the closing of a house purchase. The persons on the loan and title, as well as a representative from the lender or title firm, are normally present during the home closing. You can expect to go over the loan details at the closing. Any additional closing fees that aren't included in the loan will be paid at this time. In the case of cash-out refinancing, you may also expect to be compensated by the lender if they owe you any money. This cash will be received when the transaction is completed. You can consider the loan closed once all of the documentation has been signed. However, a borrower has a 3-day grace period after closing to back out of the refinance. Now that you know the process of refinancing your mortgage, Take the necessary steps you need to take and go get that money.